The clock on Jerome Powell's tenure as chairman of the Federal Reserve is already counting down. His term expires on May 15th, and that deadline is setting off a silent alarm inside the world's most powerful financial institution. Donald Trump already has a man tapped to replace him. His name is Kevin Walsh, and he just sat in front of the Senate Banking Committee under oath to lay out exactly what he plans to do with the economy. To understand Walsh's strategy, you have to look at the staggering math he is walking into. This chart shows the United States government's current national debt, a towering $39 trillion, stacked against the $30 trillion of our gross domestic product. That puts our debt-to-GDP ratio at roughly 125%. We owe significantly more than our entire annual economic output. Walsh's primary solution to manage this economy is straightforward: aggressive interest rate cuts. For the average consumer looking for a cheaper mortgage or a lower monthly car payment, that sounds like a win. But those rate cuts are a trap. They are the opening move in a macroeconomic strategy called financial repression, and its entire design is built on quietly penalizing the people who do everything right, the responsible savers. To understand exactly how Walsh's blueprint will drain modern savings accounts, we have to look back at the historical record. The United States government has executed this exact maneuver before to survive a massive debt crisis. In 1946, coming off the Great Depression and 4 years of intense wartime spending, the United States economy was buried under $271 billion in debt. Measured against a $222 billion economy, the debt-to-GDP ratio sat at 106%. By any definition, it was an absolute crisis. This line chart plots the severity of that post-war burden, peaking at 106%. Faced with this mountain of obligations, the government enacted a secret strategy. They never actually intended to pay off the principal debt. Instead, they planned to shrink the ratio by expanding the economy faster than the debt could accumulate. By 1974, the strategy had worked perfectly. As you can see, the debt-to-GDP ratio plummeted down to roughly 25. Every dollar they pay back is worth less than the dollar they initially borrowed. The United States did not erase its post-war debt through fiscal discipline. The debt dissolved through the deliberate, silent debasement of the middle class's stored wealth. Today, with our ratio 20% worse than the post-World War II peak, Kevin Walsh's three-part framework runs the exact same play. Pillar 1 is a massive rate cut. He wants to bring the Federal Reserve's benchmark rate down by a full percentage point over the next year. With inflation currently around 3%, that places borrowing rates below inflation. Pillar 2 focuses on the Fed's $6.7 trillion balance sheet. Walsh intends to shrink the money supply by selling off trillions of dollars in U.S. Treasury bonds back into the private market. Pillar 3 is his safety net. To prevent these aggressive rate cuts from immediately sparking new inflation, Walsh is banking on long-term productivity gains driven by artificial intelligence to push business costs lower. The flaw in this blueprint lies in the bond market. Walsh expects private investors, pension funds, and foreign governments to eagerly buy the bonds the Fed is selling. If they refuse, bond prices will crash, yields will spike, and borrowing costs will explode, the exact opposite of what financial repression requires. We know exactly what happens when the private market refuses to buy. In the 1940s and 50s, the government passed laws and regulations making it legally inconvenient for banks and large institutions to put their capital anywhere else. They were effectively forced to absorb treasury bonds at below inflation yields. If Walsh's voluntary demand fails to materialize on its own, the historical precedent is clear. The government will deploy legal coercion to force institutions to fund the national debt, and everyday savers will pay the tax nobody voted for. When you map out the historical record from 1946 to 1974, the dividing line between who survives this cycle and who gets wiped out is absolute. The losers are anyone holding cash, certificates of deposit, or fixed interest accounts earning below the inflation rate. Their real purchasing power slowly, relentlessly erodes. The winners are investors who recognize the trap early and secure their capital in real, productive assets. That means holding equities in companies with strong pricing power and owning real estate that generates steady income. It also means exposure to precious metals. During financial repression cycles, physical assets like silver and gold function as the mirror image to dollar debasement, protecting wealth precisely because their supply cannot be printed into existence by a central bank. Right now, Walsh's confirmation is technically stalled. Senator Tom Tillis has pledged to block his nomination until the Department of Justice drops an active investigation into Jerome Powell. But that political theater is largely irrelevant to your portfolio. A 125% debt-to-GDP ratio leaves the government with no other mathematical exit. Regardless of who officially sits in the chairman's seat, financial repression is the required direction of travel. The people who emerged from the 1970s significantly wealthier didn't get there by predicting every single political headline or rate decision perfectly. They simply understood that the debt had to be dissolved, and they moved their wealth into hard assets before the government could inflate it away.